A capital pool company, commonly referred to as CPC, is a public registered company with a conditional exchange listing. CPCs are administered and regulated by the TMX Group and trade on the TSX Venture Exchange. In fact, the investors establishing a CPC create a maintained and clean shell company without operations, with the objective of finding a lucrative and active company that is considering transforming the private company into a publicly traded company by implementing a reverse takeover, which constitutes the qualifying transaction that has to be concluded within 24 months after the initial listing. Such a transaction may only be closed after a period of restriction of 7 business days from the posting of the filing statement on SEDAR. A CPC starts to form when a minimum of 3 directors agree to commit seed funds of $100,000 Canadian to $500,000 Canadian. This capital is used to draw up an investment prospectus and perform due diligence on target companies in order to execute a reverse takeover transaction. At this stage, the CPC is not listed on the TSX Venture Exchange. The next stage is to take the company public. The CPC needs to have at least 200 shareholders in order to go public. Individuals are restricted to a maximum purchase of 2% and households to a maximum of 4% of the publicly offered shares. Between $200,000 Canadian and $1,900,000 Canadian can be raised as long as the total of seed funds and IPO funds does not exceed $2 million Canadian. Once this is completed, the CPC is listed at the TSX Venture Exchange. Once a target company is identified, it is quite common that additional financing will be required in order to perform the reverse takeover transaction. The TSX Venture Exchange demands that the CPC provides sufficient capital to cover 12 months of operations for the target company. To raise concurrent financing, a CPC typically engages professional outside assistance, like PRC partners, to secure the desired funding. Concurrent financing can range from several $100,000 to over $100 million depending on the company targeted for the reverse takeover. CPCs are best suited for growth companies that need capital for expansion. CPCs are not meant to replace early-stage seed funding, to develop an initial prototype, or secure early customers. They can assist early-stage companies to tap into this equity class. It is critical for an early-stage company not to ignore the additional responsibilities involved with being a publicly listed company. Especially on some of the junior exchanges like the TSX Venture Exchange, a company will be discarded if it does not implement proper public relations and investor relations strategies. Activities like meeting with main investors, to get analysts to cover the company, and a proactive attitude in marketing the company as a growth story have to become core tasks of the business, in addition to operational excellence to secure financial success. Selected companies listed at the TSX Venture Exchange count in these matters on PRC Partners' expertise.